Flex LNG just crushed Q2 2026 consensus.
Revenue came in at $106.8 million, easily beating the $93.45 million estimate. And adjusted EPS hit 79 cents, blasting past that 63-cent forecast.
Management also maintained their full-year guidance, still targeting $345 to $370 million in revenue. As for the stock, well, shares rallied 4.4% to close at 32.48 on earnings day.
But they slipped 1.3% the very next session, which really tells us the market is weighing these immediate wins against some structural fears.
Right, so for you retail investors watching this stock, our mission today is to dig into exactly how they pulled off this beat and what specific risks triggered that day two pullback.
Well, let's start with the beat itself, because
All right.
this was their best revenue quarter since late 2021. And the main driver is what the industry calls TCE, or time charter equivalent rates.
Right.
Those surged 31% sequentially to over $86,000 per day.
And to understand why those rates jumped, you really have to look at how their fleet is actually deployed. Most of their ships are on fixed long-term contracts, but they kept two ships, the Flex Volunteer and Flex Artemis, operating on the spot market.
Basically playing as free agents rather than being locked into a set salary.
Exactly. And because we saw so much geopolitical volatility in the Middle East this past quarter, the price to charter a ship on demand just, skyrocketed.
Oh yeah, those two free agent ships captured a massive premium. That pushed the company's overall gross margins up to this incredibly efficient 73%.
It's wild. That dynamic is what drove operating cash flow up to $63 million. They took a calculated risk, leaving a couple of vessels exposed to daily swings, and, well, the geopolitical panic made it pay off.
Right, and with that immediate cash flow secured, management made a very strategic operational move. They just completed a fleet-wide 5-year special survey program. In maritime shipping, vessels periodically have to undergo massive inspections and maintenance out of the water.
Yeah, dry docking.
Exactly, dry docking. Which means the ship obviously isn't earning money, but now all 13 of their vessels have cleared that hurdle, meaning zero scheduled maintenance off hire until 2028.
Wow, so zero downtime, basically. And that operational availability is huge when you look at their backlog. They have 51 years of minimum firm contract coverage spread across the fleet, plus they're 89% covered for the rest of 2026.
I see where this leads for the retail investor. That guaranteed ship availability plus the massive contract coverage, that is what directly funds their dividend.
Yep, they just announced their 20th consecutive 75-cent quarterly payout, keeping that yield hovering around a very attractive 9.7%.
Which looks fantastic on paper today, but...
Okay, I have to push back here then. A near 10% yield, fully serviced ships, solid contracts. Why are institutional desks maintaining sell ratings? And why did the stock slip on day two? It can't be all smooth sailing.
Well, it isn't. The short-term cash flow is solid, but the long-term structural reality is honestly terrifying some analysts. Those spot market rates we were just praising, they're collapsing. Q3 spot rates have fallen to roughly $30,000 per round trip. Last year, that same trip was bringing in $120,000.
Wait, really? A 75% drop in the spot market?
Yes. And on top of that, there's a massive supply glut looming. The industry currently has 285 new LNG carriers on order. That represents 38% of the entire existing global fleet hitting the water soon.
Okay, that completely changes the math on the dividend safety. If almost 300 brand new competitors flood the ocean right when Flex LNG's current long-term contracts expire and those ships need new charters.
They're going to be negotiating in a heavily depressed market.
Exactly. That is the core tension driving the analyst divide right now. Management reviews the dividend every quarter, and yeah, their current cash buffer and 2026 contract coverage easily support it today.
But if the market is saturated with new ships and spot rates stay this low, the payout inevitably faces severe pressure down the line. It's a classic case of securing the present while the future gets increasingly crowded.
Which leaves you with a fascinating macro puzzle to watch. U.S. LNG exports are actually up 23%, while Qatari exports have dropped 62% due to those ongoing Red Sea disruptions.
So the underlying question is whether this permanent shift in global trade routes, pulling more gas from the U.S. rather than the Middle East, can create enough transit demand to absorb that coming wave of new ships.
Definitely keep an eye on that. Follow the show for your daily earnings coverage.